Before we start, I would want you to hit that red subscribe button so that you never miss out on any of our videos. Hey guys, what's up? Welcome back to The Impeccable Investor. If you have been saving money, trying to get out of debt, or investing in mutual funds, or just like listening to radio talk, Dave Ramsey does not need any introduction. Dave Ramsey has helped a lot of people pay off their debt and lead a life without paying off interest expenses. But after all, he is human and has made some mistakes. Today we look at where Dave Ramsey went wrong on investing. Without any further ado, let's dive in. One of the most crucial aspects of asset allocation is having more than one type of asset. The 4-fund mix of Dave Ramsey comprises only one type of asset. There are only stock funds, no bond funds, or cash, money market, or stable value. A portfolio of 100% stocks is simply inadequate for the vast majority of Dave's audience, and an asset, in the opinion of your humble mutual funds guide, an asset allocation of 100% stock funds is wrong for most human beings on the planet. A combination of 4 funds has great potential for duplication/overlapping, including when an investor holds 2 or more mutual funds, holding identical securities. Imagine an inexperienced investor, following Dave's example, looking at a 401k plan that offers mutual funds to Vanguard. Worsening things, an investor might understandably think that no international stock fund will invest in stocks found in its domestic growth or growth and income fund. If the fund is categorized as world stock, however, it could invest a percentage in US stocks. This creates more overlap, less diversification. To sum up, the 4-fund mix Dave could possibly have the same diversification as just 1 or 2 stock funds. If and when US stock prices fall, the account value of an investor could drop a lot more than if she had a diverse mix of stock funds and bond funds. This type of account value loss frustrates investors and causes them to stop investing altogether. Dave is a big advocate of active mutual fund management. He's so insistent that it's embarrassing about this. The data is overwhelming, in favor of an index approach. The best actively managed funds are the ones that are most index-like. Low costs, low turnover, stable strategy. Dave insists that all debt must be paid before investing. This is more of a rigid philosophy and cannot be proven right most of the time. As Dr. Corey S. Fawcett has said regarding paying debt versus investing, it depends on how the debt compares to the present and the future. If you are drowning in debt and struggling each month to get by, then the first step must be to restore a reasonable balance. If, on the other hand, debt is not overwhelming in your finances, then you can take a more balanced approach. You may be able to pay down debt ahead of schedule and at the same time make this year's maximum retirement plan's contribution. Most doctors are in position to do both, if their lifestyle spending present is also in balance. Dave repeatedly emphasizes the 12% return figure in calculations and conversations all the time. I heard a lot of justifications for that, but you can't really explain it. If you plan to compound your money at a figure of 12%, you're going to be very disappointed. Even if we witness good economic times throughout your investment career, even when you're using an active portfolio as Dave advises, if I were you, I wouldn't expect my money to compound a decimal place higher than 7%, and that's even a stretch. It's a stretch especially if you're not 100% stock. We all know how hard of a job it is to maintain 100% stock portfolio. The worst about Dave's advocacy for actively managed mutual funds is that he isn't telling you how to choose a good, actively managed fund. He just tells you to seek out the one with the best performance in the past. There's a reason that this principle fails. Because one can always turn the course of things to be a better investor, or one can just throw all the hard work down the drain to lose all he earned. Past performance does not predict future performance. That's because it's true. So there you have it, folks. Next time you listen to Dave Ramsey, just make sure you remember this article and keep in mind where he went wrong, so you can go right and not follow the footsteps of those who do not get it right. Brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss out on any of our videos in the future. Also, watch the 2 videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.